Trading Market Technicals morning call video for Thursday, January 17th. We had yet another inside day, fractional gains, Dow down 23 because of Boeing, Nasdaq up 6, and S&P up 0.29. Energy is continually building here, so there will be a resolution one way or the other. My guess is that it will be to the upside since we are in an uptrend. We need to follow the trend, but it's been very, very boring since the first day of the month. Honestly, nothing has changed. We've been on an inside day until we had this little pop here. This is on a 10-minute spider chart right out of this range, and yet we continue to be range bound yet again. Nothing really is moving. As just a quick note here for investors and traders, have to be patient. If you need to be in cash for a couple of days and not do anything, rightfully so, step aside. And it's also okay to try a trade here and there. Losing is part of the game. Keep the losses minimal and your palates dry for when the volatility steps in, which I feel is going to happen almost any day. And I am very surprised that this market hasn't gone anywhere in the last 10 trading days, 12 trading days. It's kind of mind-boggling. However, it is what it is, and when this is what we're dealt with, so we're going to just be patient and just continually monitor the market and make sure that you do your analysis right at night. So when the market does move, we're ready for it. I do see the market topping here. That does not mean that the market can't pop to the upside before that the last move before we start rolling back over again. Topping is a process, and that means that we need to be patient and identify the warning signs, which I've shown on many videos before. Let's take a look as we move on. Just take a step back and wait and see when this market moves. Prices would pay us. Obviously, our indicators are secondary. Okay, so that means we can move up easily, even though we are overbought, and our indicators are telling us that we're looking to roll over. That could still happen easily, and then we could start rolling back over again. But again, just wanted to make that point. All right, so let's take a look at the this is the 10-minute chart. I'm going to run through the indicators. Nothing really has changed here, as you can see. Bullish percent index again continually climbing into the stratosphere here. So what we want to do is we want to be patient, and we want to make sure that if we are swinging, we want to make sure that we either protect ourselves or we tighten the stops up every day. Now we are grinding higher on low volume, and that's normal. That's exactly what the markets do here. So again, we're up at this topping area. Here's the spiders down below. Just a word of caution here. Again, just want to make that note. NYMO really hasn't done anything, but just kind of rolling back down again, up 17. So we are almost neutral now, so that means that we have plenty of room to pop up. So this is what I'd like to see, is the market really get us up here, pop up into this overbought area, maybe into that 60-70 area, and then I would like to short the market. Or we can really pull down hard, and then we're going to need a catalyst for that. And I don't see, unless we catalyst could be the debt ceiling, obviously, but we need something. Something has to really push us one way or the other, and there's no sellers in the market, and the market just grinds higher on no volume. So it's very dangerous to trade right now, as far as holding positions. Take a look at the tick chart just to show you. Here's a tick plotted as a 10 MA, and as you can see here, up at the lofty levels here, and up in here too as well. Okay, copper. Take a look at copper, really underperforming right now with the general market. Copper versus the S&P ratio chart. As you can see here, it's underperforming. Not really what you want to see, but we did have a nice big move in copper, pulling back nicely here. Volume was pretty decent, so we do have some distribution in copper, so that's something I really wanted to keep an eye on. Also, take a look at the 10-year. This is the 10-year yield. Yields rise, markets go lower, inversely correlated. And as you can see here, we are now kind of flagging into the upper area of resistance of this symmetrical triangle. Once we see this start to move again, then I think we might have a little bit of pressure in the markets itself. Take a look at the CBOE. Again, very bullish. And I take it as a contrarian. When you get overly bullish, definitely use a word of caution. VIX down at 13. I'm surprised it's not at 0. Only kidding, but it just amazes me how low the VIX is. I've virtually never seen it this low. I don't think 13.5. And again, looking to break this lower. So there's no fear at all in the markets, and that's what really scares me as a technician, saying, well, we might. When you have extreme complacency, you got to be careful. That doesn't, again, that does not mean the markets are going to start selling off right away. It's going to take time, and that's a process here, and that's what we need to really identify. Okay, here's a spiders chart. Range bound here after the first breakup of the new year. We've been literally range bound, and now we're basically in the upper end of the range, as you can see here. And this little channel that I drew, we're back in the channel, kind of walking this line up here on the lower trend line. Volume has been low, and as you can see, we're at 98% in the stochastics. Really, really overbought. And again, if we could literally roll down again and flag into this 20, I'd be a better buyer down at that area than I would be up here. That's not my trading plan to be buying stocks up at these areas, unless it's of course a day trade. Spiders, as you can see here, we have a little bit of a wedge forming. We are at the upper end of the range, and we've just been literally, as you can see, these little bottoming tails here for the last 5-6 days, literally just sitting in this range, inside day, very, very boring, and our CCI starting to roll back down again. Okay, so that means to tell me that the momentum is waning. Definitely use a word of caution. Now, 60-minute S&P. We have some negative divergence here starting to develop. Actually, it has been developing, and we have this little uptrend line here. So what I want to see is, now we could pop here. If this does pop higher, it could negate this negative divergence. Okay, so we want to watch and see what this divergence that's been forming right now, negative divergence been forming. If in fact we start to roll over and we break this lower trend line, we could lose a good 30, 40 S&P points rather quickly. So this is something I'll be monitoring as well. 60-minute S&P cash. Again, negative divergence that has been forming. We want to see this, how this is going to play out. If we do pop to the upside, this could be negated. So again, just a word of caution. 30-minute S&P, as you can see here, I mean, I could roll this all the way back to the first day. Just literally, the market has been just brewing and just literally building energy. Bollinger Bands, I don't even know if it can get any tighter than what it is at this moment. So when the Bollinger Bands get tight, especially on a 30-minute chart, look for a big, big move. We did have a little move here, and I thought that might have been a start of something. And sure enough, we did kind of drift higher, and then we've literally have been in range. We've been in the 5-6 S&P point range the last 5-6 days. That's not a real good trading market right now. So again, patience is a virtue. Stand aside, be in cash, small trades until this market aligns itself again. Diamonds, just real quick, as you can see here, real bullish. We're at 98% as well. MACD's up real high, low volume, just drifting higher. I'd love to see this market pull back in again, maybe fill the gap. Doesn't have to, maybe even to the 20-day moving average, the bottom of this area here, and then look to catapult again higher, at least one more time, and then maybe get a little bit of a sell-off in the spring. Again, a longer-term picture. Transportation sector, IYT, nice breakout top, and as you can see here, forming a little bit of a wedge, very bullish, 97%. A lot of these sectors, these key sectors, are way overbought. So we are definitely due for some sort of a pullback again or a correction. I did say last week, I said, look, we'll probably get a 1 to 2 day pullback. And sure enough, we were right in here. And it literally was, I believe, 1% or something, which is not even a pullback to me. That's just all it is, just a small consolidation, pullback, low volume. And that actually was bid up all the way up here. And you could see what happened. So we rallied right back up again. Again, word of caution. Doesn't mean you can't stay long. Protect yourself, puts. Maybe an inverse ETF if at all, or if anything, just tighten your stops up. But again, right now the market is in an uptrend, and I do favor one more push up higher. But if we're going to break lower, we need some sort of a catalyst. Something has to happen. Okay, and Russell looking really constructive. Again, sideways, 95%. MACD's at 1.26. Volume is a little bit lower than what I want to see, but consolidating sideways is also a bullish thing. But we do have this big, big gap here, so something, word of caution. But we have this inverted head and shoulders on a daily. 89.50 still holds true. We could still dip lower and still have this head and shoulders, inverted head and shoulders still be valid. So just, again, just take note of that. Apple. Now, I want to talk about Apple for a little bit. I mentioned yesterday, before 2 days ago, I said, you know what, I don't like it. I don't like it here at 500, and we traveled all the way down to the low of 480, and I said 467. I have this here for like the last month or so. My take on Apple is this, and I show you on a weekly chart. We are oversold, no question about it, right? As you can see here, all the indicators. Now, let me just jump to the daily chart here. Now, we do have a head and shoulders pattern which measures around the 460-ish area. That longer-term trend line, it comes in around 467, 470-ish, give or take 4 or 5 points. Yesterday we took back all of our losses from the previous day. We had one downgrade and a tier 1 firm, two tier 1 firms basically spoke positively about Apple, about earnings and how you should buy it. And obviously shorts got scared and they started covering. And that's really what it is. Here's my take on this. Now, my thing is that Apple may want to fill this gap here to the 20-day, which comes in around 421. I think that if it does fill the gap, I think it goes lower one more time. And it does look like it here. This looks like the start of a bullish falling wedge, right? 1, 2, 3, 4, right? And then we have a fill the gap type thing, and then we could break lower. Depends on how you look at this. But either way, I think we have one more push, and then a break lower, and then that would be the cue to buy it. Now don't forget, Apple reports on the 23rd, I think after hours. So it depends on how you play it. I don't hold into earnings at all. That's not my trading style. But there may be a large fund or some market participant that may want to get out of Apple prior to earnings. So you might get that one big push or that whoosh lower. And this here, we did have a little bit of capitulation here. Not enough for me that I think that this market, that Apple has bottomed here. Now, I did mention yesterday morning that we have positive divergence brewing here. But as you can see here, if I take this away, the stochastics are still wide open. They need to curl up. So there's a lot of work that needs to be done here. But nonetheless, we do have some positive divergence that has formed. And is forming, and that might need a little bit more work. So maybe one more pop, 2-3 days, back to the 520, and then a move lower, and then a big rally back up again, and that probably would get you back up to the 200-day eventually, 590. I'm 595, right into that 200-day moving average, which is 596.05. That's my take on it. But again, technical analysis is king, and that's what we read. And this is what I'm reading from the chart at the moment. So we might want to fill the gap, and then when it fills the gap, we'll reevaluate and see where this thing wants to go. Remember, the 23rd after hours is earnings, so just a word of caution on Apple, okay? And again, I mentioned yesterday, technically, seasonality, the tech sector favors a bullish move. So and that's basically coming off of Christmas. So I think Apple will probably report some decent numbers coming in. But again, only time will tell. So we just want to use a word of caution here. Look for the gap fill and then reevaluate it. But it looks like here a bullish falling wedge forming. Still has a lot of work to do, though, before it actually breaks to the upside. And again, anytime a wedge breaks out to the upside, it usually back tests before it continues. Okay. And lastly is the Qs. Sideways consolidation again, as you can see here, 89, not as much as overboard as the other sectors, but again, still overboard. All right, guys, that's really about it. I know it's been quite boring lately, and I apologize, but I wanted to show you what I'm seeing, and I would love to really either break out of this range, get a real quick pop to the upside, and just get some volatility. It really doesn't matter what direction, because we can make money on the buy side and on the sell side. It's just we need some movement here, and this is exactly what we've been seeing. Sideways consolidation for the whole month of January, from the beginning of the year. All right, guys, be safe out there, and we'll talk to you tomorrow. Have a great day.